Hello, everyone. Hopefully, we are logging on all right. Hopefully, there's no issues with that. If there are issues, I guess if you're not logged on, it's hard to talk with me to sort out your issues. But we do have close to 10 people logged on here. We do have 40 people signed up here for today's talk. So we'll wait maybe a minute or two. We are right at noon. That is our set scheduled start. So again, thank you for those who have joined on with us. We'll give just a minute or two here to have a few more people log on. With that, I can do a little bit of a recap. So this is part two. We have a three-part series here we're going over. We started last week on Monday. We went over this fruit farm. It is Easy Living Acres based out of central Minnesota. They have some apples, they have some strawberries and blueberries that they have on their farm. And we're going over their finances, what to look for, how to calculate what these different financial ratios are, and then how to use these to help better your farm decision making. That's some of the takeaways we're trying to go over. And last week we talked about their balance sheet. So we looked at both their January 1st, 2020 and their January 1st, 2021 balance sheet, and we looked at how they've grown, how they've improved from one year to the next, and then also just areas that they're really strong, areas that need improvement. We just went over the balance sheet in general, things we can calculate from it, different financial ratios. We went over their liquidity, we went over their solvency. So again, hopefully most of you were on that call last week and found it helpful. If you were not on that call, we do have it recorded and it is available through the University of Minnesota Extension. The Agricultural Business Management team, that's the team that I am a team member of. We have a YouTube channel and that's where that is located. I'll send that out in a link to where that, again, balance sheet webinar from last week is. I'll send that out. I'll also send out the link here for the income statement talk today. And then next week, we'll go over this same farm's cash flow. So again, we'll look at what the cash flow is and how we can use that to, again, make some good decisions for our farm. So those are the things we'll be going over here. Looks like we have a decent crowd here with us already. So I think we'll kind of go ahead and get started. But first off, I did not do this meeting alone. I'll be kind of the main presenter here today, but I want to mention out Natalie Hoydal. Hopefully I'm pronouncing that correctly. She also is helping us out here today. So I'll let her introduce herself and then also her coworker.
Sure, thanks, Nathan. Yeah, so I think most of you know me. I'm Natalie Hoydal. I'm the statewide vegetable educator. And then Annie, who may or may not be here, she's having a furnace problem, is the statewide fruit educator. And so we just worked with Nathan a little bit to give, he works more with field crop and livestock farmers. And so we just worked with him a little bit on adapting, I guess. But Nathan is pretty much going to run things today.
Well, thank you, Natalie. Again, she helped spread the word out about this event. She works a little bit more in the fruit and vegetable world, as I typically work with kind of row crop operations and dairy operations. A little more of the larger enterprises is where we typically focus. But again, we don't want to forget about some of the smaller farmers out there and some of the fruit and vegetable growers. So we do want to do some education for them. And that's what we're doing again today. So again, I want to thank Natalie and Annie for helping out with that. Again, Annie has a little bit of a furnace issue, and unfortunately it had to happen on the coldest week of the year. So hopefully everything works out well for her. And she does do a great job. She's pretty vocal with some of the educational workshops that she does. And she puts a lot of information, again, just on the University of Minnesota Extension's website to help better fruit and vegetable growers. So with that, we'll go ahead and get started. Again, this call is going to be recorded here today, and it will be shared on that same YouTube channel that I will mention or forward that out towards all the registered participants. So This information, again, will be available in the future. And if there's any other questions, feel free to reach out to me directly and we'll get those answered. If there's any questions as we go along today, we'll have an hour-long discussion. We'll be done right around 1 o'clock. So again, hopefully everyone can bear with me over this lunch hour discussion. But if there's any questions, there's both a chat box. Again, either it's going to be the top or bottom of your screen. You'll say chat box. And it might be kind of hidden under the more options. And then there's a drop-down menu that may or may not say chat box. So it should be able to find it. Type it in there. That'll pop up on my screen and I'll get those answered right away. Or you can simply unmute yourself and just speak what your question is. Either is fine by me. I want everyone comfortable and able to ask questions that they have as we go along. So with that, we'll go ahead and get started. Again, the program approach we have here today is we have a case farm. So those of you who did join our call last week, we introduced this case farm. I believe we have Fred and Wilma Smith. They have Easy Living Acres, and they have this fruit farm that they have. So again, we'll go over this case farm in a little bit, but we're going to analyze their hypothetical farm. So it's based somewhat on several different fruit and vegetable farms that are operational in Minnesota. We changed some names, changed some numbers to make it anonymous, but it is a very realistic financial analysis that we'll be going over. So again, we'll highlight this case farm in a little bit. And then again, last week we went over their balance sheet, and today we'll be looking at their income statement. So again, balance sheet we did last week, income statement we'll be focusing on today. So again, these are some of the objectives that we would like to have all of you participants understand. So looking at the farms and determining its farm financial condition, we're looking at profitability. So profitability is going to be our main takeaway of today. Determining, how much money the farm is actually making. Here's a quote here. People in business usually fall into 1 to 2 categories. Those who are fascinated with numbers and those who are frightened by them. The quote does go on to say that numbers are neither magical nor mysterious nor menacing. They merely reflect other decisions that you have made previously in the business. So the point of this talk is, let's not be scared of these numbers because the numbers just reflect how the business has operated and what has happened on the farm. And the documents that we'll be going over that I also sent out in that email, they are in a FinPack software program. So again, we can see it's this comprehensive farm financial planning and analysis software. So the balance sheet we went over last week, the income statement we're going to go over today are in this FinPack software output. So maybe you've seen income statements before, and this one looks a little bit different from what you're used to. It's just simply the software program that we are using. So FinPack is a University of Minnesota program. It's widely used across the nation for a lot of banks use this to help with their financial analysis of farms and businesses that they have as lenders or as members of their bank or lending institution. So it's a widely used program. We are again going to go over it here today. You can see there's a link at the bottom if you want to look at FinPack in a little more detail. Check out their website when we're done with this call, or ask me future questions or when we're done with this call today. So again, income statement. So first up, I'm going to show up this case farm again. I'm going to hopefully pull it up on my screen, and hopefully this is going to work here. And hopefully everyone can see this Word document that I did send out in an email here. But we have Fred and Wilma Smith. So we just want to keep this farm in mind when we're going over their income statement. So maybe hopefully this looks somewhat familiar to you if you're aware of some fruit farm finances and what a farm typically is going to look like. We can see they own 40 acres. 9 of it is going to be used right now for their fruit farm. Easy Living Acres is the title of it. So they have, about 15 acres that are wooded. The rest is going to be pasture, tillable. They have 5 acres of apples, 2 acres of blueberries, 2 acres of strawberries. So they do sell about 200 broiler chickens each summer. They sell those off on their farm as well. They have raised some pumpkins in the past. So we'll see that in their income statements. They do use several different channels for selling. They do some U-pick with the berries and apples. They have an on-farm store. They do go to a farmer's market, and they do direct to one local restaurant and a school. So we can see the wife, Wilma, she's a nurse at the local hospital in town. She does provide additional income and a major issue as well of healthcare. So she provides healthcare for the family. The husband, wife, they're near 40. They do have 3 children. They help out on the farm when they can. You can see they're 12, they're 10, and they're 8. So they're starting to get a little bit more involved as they get a little older. So they started this 15 years ago as a hobby farm, and just kind of kept planting more trees and expanding their berry operation. So they did start this. They would like to buy a utility tractor to help ease some of the burden on their farm. Fred's been watching the markets a little bit and just looking at some classified ads. He wants to spend about $20,000 on a tractor here. We can see that he wants to put $3,000 down and finance the remaining $17,000 on this tractor purchase. So you guys, as participants on this call, we're going to go over their income statement, and you are going to be their lending review team, and you are going to review the financial information and determine whether or not you would finance this loan request from Fred and Wilma Smith, mainly for this tractor purchase here. And then we can also see that they do want to expand their operating loan that they use in the springtime to help get everything going before revenue does come in here through the summer months with their fruit. So again, there's 2 questions we have. Would you finance their request on the tractor and expand their operating loan? So those are the 2 questions we'll focus on today as we look at this Fred and Wilma Smith Easy Living Acres farm. So again, keep this case farm in mind. And now we'll go back to the PowerPoint, hopefully, and continue our talk here today. All right, hopefully everyone can see the PowerPoint again after I flip back from the Word document. So if you can't see the PowerPoint slide here of the income statement, please speak up. Otherwise, I will assume we're good to go. Okay, so again, the income statement. So we're going to go over a brief description of what is an income statement and what can we do with that. So the purpose of an income statement is going to look at profitability, measuring profitability. How much money did we make during the year? So again, it says time period on the screen here. Typically, our income statement is going to be over a 1-year period. So maybe some of your businesses has a fiscal year, not a calendar year. So maybe it's not January 1 through December 31st. Maybe you do March 1st through February 28th or July 1st through June 30th. There's different ways to do it. But again, usually we're looking at a 1-year period here. So with that in mind, how much money did we make over the last year? Again, these are going to be very important for looking at profitability and then also transition planning. So we can see the ages of the farmers in our sample case farm here are about 40 years old. So the transition planning is not quite a super relevant topic for them. They're probably going to farm for the next 20 years without too many concerns. But again, if you're the primary farmers and you're maybe pushing the 60, 65 timeline, or even before that, you need to get a transition plan in place. You know, maybe you're pushing 50 years old and you want to transition and it's going to take a few years. Do you have someone in mind to take over, or what is your transition plan? Are you going to sell out? So using this income statement to determine if there's enough money on the farm that we can make for a transition to happen smoothly is important. So again, that's another use of this income statement, is for transition thought planning or planning in general. So the profit equation, right? We do need to make money on the farm. If we're not making money, if we're not making profit, the farm might not stick around very long. So the profit equation, we're going to take our farm revenue, subtract our farm expenses, and then we'll get at our net farm profit. So again, that's a very simple equation. We'll go into a little bit more detail as we go along this talk. But again, keep that in mind. That's the equation we're looking at. Revenue minus expenses. So again, several different ways to look at an income statement. So cash. Are you using cash-based accounting, accrual-based accounting, or cash plus or minus these inventories and depreciation adjustments? So we'll call that accrual adjusted income statement. So there's several different ways to do this, and we'll talk about the differences of them. Income statement again. So problem with tax forms. So the most basic, if that's the proper term, the income statement that most of you are probably familiar with is going to be a Schedule F tax form. Your Schedule F tax form breaks down your income, it takes away your expenses, and gets your final number there, line 31 of net farm income. So again, that's an income statement. That's again probably the most familiar ones that you as participants are used to seeing. You're more familiar with this Schedule F income statement compared with a FinPAC analysis that we'll be going over today. So again, income statement or a tax Schedule F income statement is going to be cash based. And there's not necessarily something wrong with that, but some of these tax rules that are in place can distort income, namely fast depreciation. You can kind of do some income averaging. There's just a lot of depreciation, a lot of different ways to kind of alter your income a little bit. So the Schedule F income, the whole point of doing taxes, for the most part, a lot of farmers' point of view, is to limit your income as much as you can to pay the smallest amount of taxes. No one loves to pay a great sum in taxes. And with some of these tools that are around for small businesses and farmers, they can decrease that a little bit with depreciation and different expenses that they can take. So the point of this slide is a Schedule F income statement is not necessarily the most accurate income statement for a farm. Just because you didn't make a ton of money on Schedule F doesn't mean you didn't make a little bit more money than is shown. And we'll talk about that here. So the accrual method. So again, that's going to recognize revenue when it is earned, and the expenses will be recognized when they're incurred. So the income is going to be more accurately matched with expenses. And again, we have some examples here. So the accrual adjusted method, you're going to take your net cash income and you're going to adjust for inventory changes. So our biggest example, I think it's later on, but I'll hopefully throw it up here to keep everybody in the loop. Just because on your Schedule F, it says that you made $10,000. Okay, let's just say that you have a big inventory of apples or apple cider or maybe pumpkins left over in your cooler, in your shed. You have $10,000 worth of inventory that you didn't sell yet. Does that mean that you only made $10,000 that year? Or your inventory that you haven't sold yet, because it's not sold, doesn't count as income? Should we include those inventory in our income for that year? So that's, again, just one of the big differences that we want to highlight. So the accrual adjusted income statement here, we're going to look at our beginning balance sheet. Again, we already showed our 2020 balance sheet from last week and our ending balance sheet, the 2021 balance sheet. And then we can look at the cash accounting record. So that's kind of how we get to this accrual adjusted income statement. Again, you can produce an accrual income statement without using accrual accounting. So again, these inventory changes are the big highlight that we want to show here today, that again, Schedule F income statements for tax purposes do not show. Okay, cash income can give the wrong profitability signal. So we can have this 2 or 3 year lag in recognizing increases or decreases in profitability. Again, inventory values that are adjusted annually. Again, just think of for a corn and soybean operation, if you have soybeans in the bin at the end of the year at harvest time, maybe it's only worth $9 a bushel. And like this last fall, prices really rallied. All of a sudden, soybeans are $13 a bushel. We had that huge adjustment in our inventory values that are going to change our income profitability. So again, that's another thing we want to highlight. What is our inventory value at? Because prices do change. They fluctuate throughout the course of a year. Again, cash income can smooth out some of the cash flow bumps, but it doesn't, again, reveal true profitability. So the accrual adjustments for income reveals these profitability changes within the period. And again, hopefully some of these examples we'll show in the next 10 minutes or so make this point a little bit more clear. And again, if there's any questions, feel free to unmute yourself or throw something in the chat box, because at least on my screen, I haven't seen any chats come in. So again, feel comfortable asking any question. We're here to get them answered. So again, some examples here. So the accrual income, the revenues are going to be recognized as income when they're earned, not when the money is received. So we have an example here where your neighbor owes you for custom combining or some other form of harvesting at the end of the year. So in the cash accounting system, income is going to show up when he pays you. So that's how you're going to be the tax reported method. So maybe he's going to pay you in January versus when it actually happened in September, October, November, whenever this harvested occurred. Whereas in the accrual method, the income will be recognized when the work is done. So if you combine or again, some other form of harvesting of some fruit, you will recognize this in the accrual method the day you harvest it. It'll go under your accounts receivable. So you say, I helped Farmer Bill pick some apples, accounts receivable there of X amount of dollars, even if it didn't hit your checking account yet. So again, that's some differences between accrual and cash. Okay, and again, the accrual adjusted method calculates ending accounts receivable minus beginning accounts receivable. So again, with that accrual adjustment, we'll be looking at the changes in our accounts receivable from 1 year to the next.
Nathan, could I ask a question?
Yes.
If your season pretty much finishes up, so we have a fruit farm and we pretty much sell all the fruit by fall, and we don't have a lot of inventory that hangs around after the calendar year. So we're just doing calendar year, what do you call it? Bookkeeping. Is there, I'm starting to get the idea that this accrual adjusted system might be better if you had kind of inventory and things that hung over from year to year, but if you don't, is it simpler just to do cash system?
Well, I understand your point about the inventory changes, but another thing that we didn't talk about yet is going to be what about your prepaid supplies, right? Or some other things like that. So maybe you have packaging that you put your fruit in when you sell it. Do you buy that in November? Do you buy that in March? If you buy it in November, it's going to be for the next year. So that will be another accrual adjustment as well. So maybe it's not necessarily fruit inventory, but other supplies, or maybe you have some, chemicals that you use on the crops. If not everything is used up on December 30th, you're not using that for 4 or 5 months yet. So that would be another accrual adjustment to use.
Okay, that makes sense. And then maybe if you can also address, because these are mostly perennial crops, so like when you get new bushes or trees and do a bunch of work on them in 1 year, and then you don't get any harvest off of them for several years, maybe that's is that depreciation? Is that growing value? Is that?
Yeah, so what do you value the crop at? Like you said, if you plant, strawberries, you usually don't harvest them the first year, right? And that's
Yeah, and we're talking about like apple trees or pear trees where it
apple
might be
trees
8
where
or
it takes
10, 8,
several
10 years for pears.
to get the harvest off. So where do you put that value at? Again, that's not necessarily, I'm trying to think how to best answer that. So you're not getting any income off of those crops, and yet you still have some of those expenses, right? So I'm just trying to think. So your question is just how do we calculate that into our income statement?
Yeah, I guess what I'm hearing you sort of contrast using cash-based accounting versus accrual-based accounting and trying to decide like which one would serve us better. And so far, I guess we've done cash, but I'm trying to think of like what are the things that have sort of like year over year factors that we should be taking into account if we're going to switch over to accrual-based accounting. Which one would serve us better?
Just another point, for tax purposes, you're probably going to continue using cash-based accounting, right? It's a little bit easier, and I think there's a little more tools you can use to kind of fluctuate your income with some of these expenses that you talked about. If you have no income from your tree crops, when you initially plant them, you do need to, again, have that as an expense, right? And cash-based accounting for tax purposes makes that a little simpler. But the point of this talk here is in your income statement adjustment or your income statement for the year, looking at your inventory changes, your supply changes at the end of the year to include that in your income for 2020. So I think, I'm not saying you necessarily need to change your accounting system to accrual, but looking at these accrual adjustments at the end of the year to show that, hey, my income's probably a little higher than we actually showed here because we maybe don't have much inventory left, but we have a bunch of these prepaid supplies that we bought extra for. So that, $10,000 that we paid on packaging for our apples, we only use half that. So really we have $5,000 of extra income because we didn't spend that. So just realizing that and putting that in, again, not for your tax purposes, but for your farm performance, we made $5,000 more than we actually have written down. So that's the point I'm trying to get across. Not to change your
thanks. That makes sense.
System.
Yeah.
But looking at your inventory and supplies at the end of the year to see what's left. Does that help?
Yeah, that makes sense.
Okay.
Thank you.
All right. With that, we'll keep going. So we have a couple more examples here, and then we'll look at the example income statement for our farm here. So again, here's this, again, one of these accrual adjustments. So we have a cash statement here on the left-hand side of you, this Jones Farm. Gross income, $500,000. You can see their expenses, $450,000. Net cash income, $50,000. They have some depreciation of $40,000. Schedule F, cash income, $10,000. Again, these are real simple numbers for analysis here. But then we can see in the accrual adjustment here, they have some accounts receivable that they didn't get yet. And with that, their Schedule F income, should be a little bit higher there to incorporate that accounts receivable. Okay, again, just another example here, accrual expenses. So expenses will be recognized when incurred, not when paid. So again, you owe your neighbor for custom combine at the end of the year. Cash accounting, you'll pay it, you'll expense it when you pay him. Whereas the accrual method, you'll recognize it when the work is done. So if you did the combine in November, it'll be, for 2020, not for 2021, as with the cash system. And again, with the accrual adjustments, you'll be looking at the accounts payable at the end and beginning and recognize the difference. So again, same examples before. We have the same Jones Farm accounts payable. Instead of that $10,000 income, with that accounts payable that's still out there, our Schedule F income should be smaller, right? The deduction of that $25,000. Okay, again, we have this Jones and Smith Farm, we're going to throw in some inventory. So at the beginning here, these two look identical. But then we look at our inventory changes where Jones Farm, they have, some $100,000 of inventory in their probably corn or soybean beans in this example in the bins. Whereas in this other case, they had an inventory change of a loss of $100,000. So when you first look at it, they're identical, but then with these inventory changes, we can really get these drastic changes all of a sudden before they're the same. Now it's a difference of $200,000. So again, maybe this is a drastic change, but again, inventory changes are relevant to our income. Okay, so this is the case farm income statement that again, hopefully everybody got up or got in that email. So we can see this is for 2020. They had 252 bushels apparently of apples that they sold, some $15,000 worth of blueberries, some 6,000 pounds, $26,000 worth. And again, they did sell some pumpkins here in 2020, 135 hundredweight. And you can see some $3,000 in pumpkins they sold. And then same thing with strawberries, some 20,000 pounds. Price there, 30,000 bucks. Some additional resale items there, $450. List of expenses: seed, fertilizer, their chemicals that they use, irrigation, supplies. We can see going down the list. Their biggest expenses here are going to be interest, some $8,300. Their hired labor is a fairly high expense there, about $19,000. They're hiring some individuals to help them harvest and plant, and then their own owner wages of $15,000 that the owners are pulling off the farm is again some of the bigger expenses. So again, we'll get up their actual income statement here and go in a little more detail. But again, there's income, there's the expense side of things. And as a group, how does their price of their different crops look? Are those realistic prices that they sold for? That's according to their records, that's what they actually got. Is 60 bucks a bushel on apples pretty good? Is that realistic? The blueberries, they got $4.20 a pound. Strawberries, $1.50 a pound. Pumpkins, 25 bucks a hundredweight. So again, analyzing what they included in for prices is something we can do as a group. And again, our inventory changes. So we can see again, they had some prepaid expenses and some prepaids and supplies there. At the beginning of the year, they had just under $5,000 worth of supplies. At the end of the year, just under $7,000 worth of supplies. So again, they had this $1,900 of supplies growth in the year that will include into their income. So they had an additional $1,900 of income from that. Growing crops. So I think this $4,000 swing from beginning to end in their growing crops is they transitioned some of their new strawberries from a growing crop category into a fruitful production item where they're picking the berries and selling them. So they just took that away. So that growing crops reduction is kind of a goofy thing in this because it's really not a change in growing crops. It's almost a betterment to them, but that's how it shows up in this. And again, a reduction in their inventory of $4,000 worth. Feed looks like it's kind of a zero change. And then other assets there, we can look at their income statement or maybe even their balance sheet to see what these other asset changes are. But some $7,000 that they've grown in assets that they purchased in 2020. So their total inventory change there of some $5,200. And then we can add that to their net operating profit. And then we can look at their depreciation. So they had some machinery that they own. So they had some $10,000 in depreciation there. Again, but apparently they bought some machinery here in 2020 that the depreciation is actually a positive number. But you can see they have a titled vehicle, some $2,000 in depreciation, and their buildings and improvements. They depreciate that some $10,000 or so. So that $1,400 in depreciation is going to be taken away from their income, and their total net farm income is going to be some $9,000. If I go back a slide, we can see that their net cash income there from the previous top part of their income statement is about $5,200. $5,200 plus their inventory changes minus their depreciation gets to our final number here, the net farm income of $9,010. Okay, so we just have a random quiz here. We have some, again, random farm here, the Hatfields and the McCoys, where the Hatfields have a checkbook balance of $5,000. Change in inventory is an increase of $250,000. Whereas the McCoys have a checkbook balance of $265,000, but a loss of $10,000 in inventory changes. So with the accrual adjustments, which one's better? Which of these two would you rather be, the Hatfields or the McCoys? If anyone is willing to answer. So the answer is they end up being the same, right? As you look at the accrual adjustments, they turn out to be, they're the same. So yeah, it's kind of a trick question, but that's how the accrual adjustments will work. So again, income statement here in quick review. Revenue, that's dollars earned by the business. Expenses are funds paid out by the business. The accrual adjustments, which is kind of our main point of this talk, inventory changes and depreciation. So again, here's kind of a way to look at it. You take your income, you minus your expenses, you get to the net cash income. Then you plus or minus your inventory changes and depreciation. Okay, so now we'll look at a little more depth of their actual income statement and look at some of their pros and cons. Okay, so I will stop sharing my screen here, and then I will get up their income statement and we'll go over it in a little more detail. Okay, hopefully now everyone can see this FinPack income statement. I'll zoom in a little bit to make it a little larger. Hopefully everyone can see this. So again, we saw some of this screenshotted on the slide in the PowerPoint where we saw their income. You know, they had $75,000 in crop sales. Again, that includes mostly apples, strawberries, and blueberries with a little bit of pumpkin sales. And then they did have some of those chicken sales that also should be included in here. So again, we can look at some of these different ratios here. We can see again their gross farm income once they took in some of these other changes. And then we can look at some of these ratios on this other side. Again, these liquidity and solvency ratios we looked at last week with the balance sheet. Our profitability here, those are what we're going to highlight here today. So the net farm income, $9,000. Is that good or bad? It's positive. It's not a bad number, right? Being it's not negative. We'll look at if that's strong or negative a little bit better. The rate of return on assets is 3.3%. So again, we'll highlight that if that's high or low. The rate of return on equity is about just under 1%. Operating profit margin there, 12%. So now we can go into a little bit more depth here. Again, we looked at their apples. Is 252 bushels off of 5 acres a strong number? And I'm not very familiar with the strong yield is on apples, but here we got about, again, this 250 bushels off their 5 acres. Blueberries, again, they have 6,000 pounds, a little bit of pumpkin sales, and 20,000 pounds of strawberries off of only 2 acres. So again, hopefully you guys think these are realistic numbers. That's part of our case farm example is for you guys to look at this and say, man, those numbers look good. They look bad. They look realistic. Analyzing how your farm relates to this is an important measure. Again, we can see their seed expense, $1,300, fertilizer, just under $2,000, some chemicals. We have some, $1,700 in supplies there that they bought throughout the year. Some crop marketing, which I think was in this case more so some newspaper ads or maybe it was Facebook ads to say, hey, we got strawberries ready, come check them out, things like that. Again, the biggest expense on this farm is their hired labor of $19,000. You can see the owner, they took out $15,000 for their wages and benefits. So we can just say roughly, $1,200 a month that they drew from the farm. So is that good or bad? Is that realistic? Is that enough for the farm to survive? We saw in this case example or in the write-up how the wife is a nurse in town, and that's maybe where they get some of their other family living expenses income from. And then also, again, some of their other expenses here, insurance on the farm, their utility bill, different things of that nature. So their gross income, $76,000. Their gross expenses or the cash expenses here, $71,000. So again, we kind of looked at this a little bit already. Their prepaid expenses and supplies here, how they did gain some supplies, that they didn't use everything that they bought. And again, they did switch around some of their, I believe it was their strawberry plants and just where they labeled them, if they're either a growing crop or a intermediate asset of producing strawberry. And I think that's where this change comes into play. But it's another thing to look at. So that change in labeling their strawberries a growing crop versus an intermediate asset, decreased their income by $4,000. And is that truly a realistic drop in income? And I would argue that that maybe it isn't really an actual change in their income. So we had a question here about this $15,000 in wages that they pay themselves. And yes, it looks like the owners draw $15,000 off of the farm as their own personal income that they take from the farm. And sometimes maybe that gets a little bit blurry. Sometimes you may use the farm checkbook, maybe to buy some maybe more personal items, and things always get a little blurry. Is that a wage that you're paying yourself if you use the farm checkbook to buy non-farm things, or is that just kind of thrown in as a farm expense? Things get a little blurry. I'm not saying they don't, but this farm does clearly give themselves $15,000 as owners. Okay, so again, we can look at some of these other things down here, breaking out a little bit more, some different measures here. Again, here's their breakdown of I'm trying to think the term of crops here. So in here they do have 2.5 acres of cover crop that they broke out. They're not necessarily yielding any profit off of that, but I think it's just in their rotation for the next year's blueberries and strawberries and how they upkeep, always having producing crops. So again, here's some labor hours that they have written down, right? They have some unpaid hours there, 1,600 hours here. They have hired labor that they paid out there of $2,000. So they do break that out a little bit. So any questions on this income statement? Again, kind of showing where things come into play. Again, it breaks down. I think the biggest part here is this page 2, where we're showing, we sold 252 bushels of apples, average price $60 bucks a bushel, some $15,000 in revenue. Breaks down their 4 separate crops because they did have pumpkins in 2020. And again, breaking down what their expenses are.
Nathan, when you start using FinPack, does it sort of walk you through filling this out? Do they have pre-populated, like all these expense categories, and then you could fill in a lot of them
Yeah,
and then
they
say, oh, I
do.
don't have that one,
So-
but I do have a couple of other categories?
Yeah, so I can get up the FinPack farm and just kind of walk through the data entry part of it at the end of this call as well, if you want to see that. But I'll wait till after we finish up the PowerPoint here. Only have about 15 minutes left. But if you want to hold on, I can go through that in a little more detail. Just show you what it does look like. So keep that in mind. Okay, so we'll go back to this PowerPoint if I can. Whenever I switch screens on here, it gets a little bit goofy on my end, but hopefully we're back at the PowerPoint. And again, we'll just go over quickly here what an income statement, a strong income statement is going to look like. So again, we're going to be looking at profitability, net farm income. So again, we looked at these numbers, right? Their gross cash income, their cash expenses, their inventory changes, the depreciation to get to our net farm income of $9,000. So again, this is the math to do that. I think we went over this fairly clearly. Again, now we'll be looking at net worth growth, return on investment. So here's the rate of return on assets. So again, here's how to calculate it. We're going to take our net farm income. We're going to add back in our interest that we paid, and then take away our value of labor and management, and then divide by our farm assets there. So we can see that's 3.3%. So this is the average interest rate earned on all the farm assets that the farm owns. So let's just say the farm were to liquidate and they wanted to sell everything. Could they get a 3.3% rate of return invested somewhere else, right? They're getting 3.3% on the money they have tied up in assets on their farm. It's not a negative number. It's not 1%. If you were going to sell your farm and put that money in a savings account at a bank, I don't think you could get 3.3% right now. Interest rates are pretty low. Potentially, if you invested that somewhere else, maybe you could get that. Other investments are pretty risky as well. Here is rate of return on equity. So we have a rate of return on equity here. Again, that's the math. You take your net farm income, take away the value and labor management charge, divide by the net worth of the farm. We can see it's 0.7%. So that's the average interest rate earned on the personal farm investment. So what this couple has invested on their farm, they're getting 7% back. So again, that's not a huge number. It isn't negative. So that's one positive that we can take away. Again, this is looking at their income and how to calculate that. Again, quick summary of how their income statement is going to look like. Some big things here. We do want their rate of return on assets, and this is for any farm or business in general. We want their rate of return on assets greater than their interest rate that they're paying at the bank. Okay, if you are earning more money on the assets that you have in the business than you're paying on them at the bank, that's a positive thing. That means you're making money on this investment in those assets. So I believe our rate of return on assets was 3.3%. I think their interest rates on average are around 4%. So it's a little bit under, but it's relatively close, which is kind of a good thing. But again, that's a good interpretation of this. And then the earned net worth change here, we do want that to be above zero. You want to have a growing business that again is profitable. Okay, so we're just going to look at this farm financial scorecard. Again, this was sent in that email, and we can see we have this stoplight analysis where we have kind of a red where things are not quite so good, a little bit more vulnerable. The green is a strong ratio, and the yellow in the middle is just a little bit doing okay, room for improvement, but you're definitely not in a vulnerable position. So again, net farm income, that's going to measure the returns to labor, management, and equity investments in the farm. Again, the rate of return on assets, that's the average interest rate earned on their total farm investments. So again, here's this stoplight analysis approach for easy living acres. So the net farm income does not have that stoplight analysis. And that's because, $9,000, if you have, a 2,000 acre farm, a net farm income of $9,000 is probably not great. It really does depend on the size of your operation. But maybe with this, smaller fruit farm, that's not a bad number. We can take into account that this farm is paying the owners, and $15,000 worth of income is going to the owners for their wages. So that's another thing to interpret and to gauge when we're looking at this. So we can see that 3.3%, it's in the red. It's below 4%, which is kind of our in the red vulnerable position. The rate of return on equity, again, the 0.7% there is, there's room for improvement on that. And we want to, so there's a question that we got there about if we included that $15,000 in wages to the owners in this net farm income, that would then equal $24,000. So then again, that would be a stronger number. So yes, if they did not take that as income or didn't take that as wages for their work on the farm and left it as income, these numbers would be stronger. So again, that's kind of one way. Numbers can get a little bit tricky. If you don't understand everything that goes into them, you can really distort the numbers. And that's another thing we do want to highlight here. Again, taking that income withdrawal, reduce their net farm income. And again, that would impact their rate of return on assets, right? That'd be a stronger number if we included an extra $15,000. And same with that farm equity. That'd be a little stronger number if we included that extra $15,000. So here's kind of a stoplight analysis of some of the pros and cons. So they're in the red here on some of these profitability ratios. They did make money, but maybe not a ton. But again, we talked about some of that wage payment that was paid to the owners and how that skewed the numbers a little bit here. So again, in the red here, we can see we're looking at alternative enterprises and income sources. So maybe this farm could look at, maybe we want to grow more apples and less strawberries, or vice versa. Management decisions here, lease versus own versus custom hire. Do they need to buy these assets? Can they hire things done to make more money? Again, we're not necessarily saying one is better than the others, but looking at these different options can be beneficial. Again, in the yellow category, we talk about looking at each enterprise. So their apples, their berries, or their strawberries and blueberries. Consider input cost controls. What are we paying for seed and fertilizer? Are there ways we can reduce some of those? And again, if we were in the green, it just kind of tells us keep doing what you're doing because you're doing something right. Okay, so again, here's just kind of a brief review, a measure of profitability over a period of time. We looked at a calendar year here, January 1st, 2020 through December 31st, 2020, to show what happened. Accrual adjusted income, again, removes distortions and better gauges true profitability. So again, revenue, dollars earned by the business. So in this case, it's going to be the sale of their fruit, apples, strawberries, blueberries. Expenses, funds paid by the business. Their biggest expense here was hired labor. So their hired hands to help plant and harvest and maintain the crops was their biggest expense. And then the accrual adjustments, again, one of our biggest takeaways for this talk today is looking at our inventory changes and depreciation. So again, maybe we have supplies left at the end of the year that should kind of be counted as income because we fully deducted that expense, but there's something left at the end of the day. And maybe we have some other inventory of fruit on hand that we can sell next year. Maybe we have a CSA that we keep some apples in the fridge and sell them throughout January, February, March the next year. And again, we need to incorporate that inventory on hand to be a true income for 2020 and not income of 2021. Okay, again, here's this quick equation, taking our income, taking away your expenses, you get net cash income. And again, for Schedule F, that's kind of where you stop. You don't incorporate the inventory changes and depreciation for these accrual adjusted net farm income that we think is just a little bit stronger of an actual income statement for each year. Okay, so for this farm, their rate of return on assets is 3.3%, rate of return on equity, 7%. So again, it was profitable. They did make some money. Is it enough? That depends kind of on the family situation as well. Are they happy with the money they have coming in? The wife has the job off the farm. We did mention in that write-up, she would like to quit her day job in town and help run the farm full time, maybe grow it a little bit larger and stay at home with the husband. Is that a realistic opportunity? Is there enough money to be there? $9,000 of income? Probably not, right? But again, we talked about the extra income that they paid them. So it depends on their lifestyle. But again, ways to improve. We talked about maximizing farm income, decreasing farm expenses, maximizing efficiency. Again, other income sources are important. So we did have some net worth change here. So they did have a positive net worth growth. We're not going to highlight this in great detail. We talked about the net worth growth last week as well, where they did have some positive net worth growth that was earned net worth growth. So they are maintaining this net worth gain from 2020 into 21. So they are, again, doing some things positive. So again, the two big questions we had for this case farm were, would you, based on their income statement, borrow them $17,000 so they could go buy another tractor to help out? Do we have enough information at hand to answer that question? So next week, again, we'll meet on a Monday, the 15th, I think would be the date, at the same noon timeline, and we'll be going over their cash flow statement. So their cash flow, that'll help analyze, that's going to be looking at their 2021 cash flow. So we can say, hey, this is how much money they project to make next year, probably pretty darn similar with 2020. So the income will be probably pretty similar. Can they, if they maintain this income, afford to take out another loan? Okay, so hopefully we can go over that in a little more detail. Any other questions about their income statement? So again, a little bit different than a Schedule F income. Again, those accrual adjustments are an important feature to just to think about and write down and say, hey, I spent this extra, several $1,000s on inventory or supplies that you want to look at. So again, accrual adjustments we think are relevant to get a realistic income for your farm. Any other questions here? We're kind of pushing 1 o'clock. This is the end of our program here today. Again, we will meet again next week to finish off our fruit farm finances talk and go over their cash flow to determine again if they can afford to buy some of this equipment, mainly the tractor that they're looking.
Hey, Nathan, just a quick question that someone asked. It looks like it just went to me in the chat, but someone was wondering about if you could just do a quick review of like FinPack, and if that is if someone wants to try out FinPack to utilize it for some of these tools, is there a trial process so someone could just try it out, or do you buy a year subscription?
All right, so again, FinPack is the software we used that we showed this output here today. So FinPack has the resources. The whole point of the software is you can put in balance sheets. You can do an income statement, and they also do the cash flow. In FinPack, you can also do some long-range planning where you can do multiple cash flows over a 10-year period. So maybe you want to say, hey, I want to plant 30 acres of apples in the next couple years, and then how would that impact our revenue or income and net income? So with that, you can kind of do this 10-year planning with FinPack. There is a fee with it. I believe they changed. So it used to be, well, it doesn't really matter what it used to be. Currently, it is I believe, $149 per year subscription to the platform. So there is a fee with it. Again, it's about $149. And I believe I think last week I talked about there was like a balance sheet only version, but that does not quite exist. It used to, but they kind of took it away. So I kind of break that up, but it doesn't really exist. So I'm sorry, I hopefully didn't get everyone hyped up. But you kind of do have to either, if you do work with a farm business management system, so some of the technical colleges across the state have that farm business management program. There's also fees for that, but they will use FinPack to go over your farm. So that's where FinPack is used. Or if you want to delve into it, you can purchase that software, again, an annual subscription to use on your farm. And again, if you guys stick around here, I will get up this software. I'll bring up FinPack and share my screen to show you what it looks like and just what you can do. So when these questions are done here in the next couple minutes, I'll pull it up. Any other questions?
Did you see Jennifer just put a question in the chat?
Yep. So what about,
FBM.
so yeah, the Farm Business Management Program is run through different technical colleges throughout the state. The University of Minnesota does have a program, but it's only in Southwest Minnesota. So if you're in Southwest Minnesota, there does have a program through the U of M. Otherwise, it's ran through the Minnesota State Colleges system. So the non-U of M schools. So Central Lakes College out of Brainerd has one. There's one based out of Alexandria Technical College, Wilmer. They're kind of all over the state. I can get you resources on how to find an instructor. They do have a couple, I believe, that focus on kind of these smaller farms, you know, the non, sowing and corn and soybeans or dairy. They do have a couple that focus on that. But there are fees with that as well, but they will help go over your finances and really work one-on-one to break down these same things that we looked at here today. So again, I can show you the resources here about where to find who would be the best resource. But if there are